This is the WealthNet Market Call of the Week, highlighting investment trends that could affect your wealth. Globally aware with a geopolitical and quantitative perspective.
Hi, I'm Louis Llanes with WealthNet Investments, and today I'm going to be talking about something very important. Very often people, when they're about ready to retire, they have this decision that they have to make, and sometimes that decision is a little bit daunting because it's hard to really know what's the best thing to do. And that decision has to do with whether or not to take a lump sum from your pension or whether you should take the income from your pension. This is a very common decision point that a lot of people have when they're trying to be retire ready. So what I'm going to do today is I'm actually going to go over that decision, what are the key factors to make that decision, and how you actually put that decision together. Because the reason why this decision is so hard is because some of the variables, if you will, are unknown and they vary. They could be really a long-term thing or they could be a short-term thing, and we really don't know. So what we have to do is what's called a stochastic model, a model that allows us to look at lots of different scenarios and then find out what the best probability is, because it's not a simple this or that. So, and I'm going to really talk and dive in pretty deep into this, but it's going to be a short video, but it's going to be very intense. So you have to keep up with me. If you have a pension, you'll definitely want to be watching this because this is something that you may have to deal with if you don't already have that in front of you right now. So first of all, I want to talk about this decision. What is this decision about? Well, many times when people work for a large corporation, they have a pension. And in this pension, they are really offered an income that's for life. And sometimes that income can also pay for the income for the spouse if the spouse lives on and you pass away before your spouse. So that's also a factor. And when you retire, a lot of times when people are laid off or when they're retired or when they move on to a new job, they're put in a situation where they have to decide, will you take that income or will I take a lump sum? And if you take the lump sum, you basically obviously get all that money today, and it's rolled over into a non-qualified plan typically. And then that's invested. And if you decide to invest it, then you would basically take withdrawals from that, and that portfolio would have to last for however long you live. Now, the other issue is if you just take the income, it's just going to keep on paying until you die. Sometimes there's a payout at the end, a minimum number of periods, so you have to put that into consideration. So what are the biggest factors here? Well, the biggest factor is how much are you going to get now? What are they offering you? What will they give you today? Then what is that income amount that you will get? Does it raise with inflation, or does it just kind of stay static? And what is your life expectancy? What is your health like? And what would your life expectancy be? And what kind of returns you would earn on your investments if you decided to invest that lump sum? So the bottom line on which option to take, you have to really look at which one is the most likely to give you the highest outcome at the end of the day, depending on how long you live. So there's some challenges to this decision. However, the good news is you know a couple of things with certainty. One is how much they're going to give you. They tell you in black and white what you're going to get. Second is you know what that income is going to be because it's a calculatable number. Now, but the bad news is you don't know how long you're going to live. That's an unknown. And you also don't know what return you're going to get from that lump sum if you decided to take it. So the bottom line is you have to use a stochastic model, like I said, that estimates the likelihood of the best option. So how do we make this choice? Well, first of all, we want to estimate your life expectancy, but we also want to estimate the variance of that. So you might have a life expectancy from the Social Security table that says you're going to live to 85 or 75 or whatever that number is, but there's a probability that you're going to be, die sooner or die later. So you want to have the variance of that, and there's a way that we do that. And then the other thing that we want to do is we want to look at the portfolio returns. So depending on how your risk profile is, if you're very aggressive, then you're going to have a lot more variance in your returns every year. If you're really conservative, you'll have less variance in your returns. So you really have to assess your risk profile and then use capital market assumptions to see what that variance will be. And there's a methodology on how to do that. So we want to simulate the outcome many times. So this is really what we do. We go, okay, if we take the income from the pension, we know what this is going to look like. We compare that to if you took the lump sum that they're going to offer you, and then you invest it, and we vary the returns every year and do what's called a Monte Carlo simulation. And every year you withdraw the same amount that you would with a pension, and you compare it. Now, at the end of the day, we also vary how long you're going to live. So each simulation, if you will, which is also known as a trial, will calculate how old you are, and it will calculate what your net worth is. And then we do that 1,000 times. You can do it even more than that. We found that if you do it more than 1,000 times, you generally don't get a different result. But if you do it 1,000 times, then you can see what percentage of the time you would have been better off being taking the income versus what percentage of the time you would have been better off taking the lump sum. So that's really how you do this. So the pension decision to take that lump sum requires extensive math. It's not something that you can just guess. So don't guess this. Calculate it out. And you need to assess your risk tolerance when calculating it and be very realistic about that and know what those numbers look like in terms of variance. And be realistic about your life expectancy, that there's going to be some variation there we really don't know. And you want to be able to get that calculated. So now we'll do that calculation for you for free if you want to. You just send us an email to info@wealthnetinvest.com. So just send us an email if you want us to kind of look at that for you. We'll do that free of charge just to give you an idea on how it's done. Now, what I want to do now is I'm going to actually go into a model. I'm going to go into a scenario, and you can watch that to see how that really works. And I'll use kind of a simple scenario. So here's the scenario. Okay, so what we have here is a proprietary model that we've built because we see this decision over and over and over again. And I actually had a phone call of somebody who had this decision. I thought, you know what, this would be something to share that could be interesting for people who may have this decision point. So I'm going to use this as an example. If you look here, we have somebody who's 60 years old, and their pension is offering them $2,500 a month, which is basically $30,000 a year. And they're about to retire, and they need to know, what should I do? The company is offering them around $500,000, as you can see here, for this. They can take that $500,000, or they can get $30,000 a year, $2,500 a month. And there's an inflation adjustment. So every year they pay a little bit more in income. Now, most pensions don't do that. Most of them are flat. This particular one has an income rider. So basically, every year it goes up. So what will happen is if you scroll down here, you'll see the income starts today at 60 years old, and it goes to $30,000. And then every year it goes up. Okay? So now the life expectancy, we look at this particular person is in good health. So we're just going to take the life expectancy tables from the Social Security Administration based on them. Somebody who's 60 years old now, they should live to 84.48 years. But we have a variance, and we wanted to have a confidence band. So what we did is we're simulating that on the worst case scenario, they'll live to age 94.48. Close to 95, and on the low end that they would live to 74. So now we're going to run 1,000 trials, and if you see here, you see right here it says life expectancy in trial. Every time we do a trial, that life expectancy is going to change. Okay, so the life expectancy trial, it changes over and over and over again. So what we see here, if you look here on the right, what this shows is the number of simulations. So there's simulations 1, 2, 3 going all the way to 1,000, just keeps going. And each one of these values here, the terminal wealth, what that is how much money you had after you took your withdrawals out, the same withdrawals that you did on your income, and you invested the portfolio. So let me explain that a little bit more. So in this case, the company is offering $500,000. So we get $500,000, and then we take out our income, which is the same as the income you took out in the pension, right? And then we earned a return. Now, what's interesting to note here is that the return is varied every single year. So if you see here, you see a return every year, right? So each trial, it's going to change the returns in every year based on our capital market assumptions. So our capital market assumptions are here. In this case, we're using a 60-40, 60% equity, 40% bond, because this is a moderate type client. And generally, you want to really start that as a base case, in my opinion, because you want to keep your volatility lower. But based on our capital market expectations of return and risk and correlation, That's an expected return of 7.14% and a standard deviation of 10.42. So what does that mean in layman's terms? That means that the average return will be around 7%, but it's going to vary plus or minus 10%. But it's going to even sometimes be even more than 10% because just assumes a normal distribution, which is a reasonable base case to use. So each trial, not only are we going to change the return number for 1 year, we're going to change them for all the years that you live for every year, right? So it's really running it over and over and over again. Okay, so in this case, this particular client, if you look at this table here, this shows the probabilities. This shows out of the 1,000 times that this was run, 559 of them, the lump sum was better. So that's about 56% of the total trials. And only 441 was better, so 44% of the trials were better if you took the income. So that's a pretty balanced outcome. So in that scenario, really, either one, it's kind of a wash. You could do either one if you want more flexibility, take the lump sum. If you feel like you're more conservative, you just want to know that money's there, take the income. So, but what if they offered them more money? Now let's assume that they instead offered you $750,000 for this. If they offered you $750,000, what you'll see is that the lump sum was better 926 times. So 93% of the time, the lump sum was better. Now this kind of thing does happen where some companies just say, look, we want to get this unfunded pension liability off the books. And we've got to get some of these people off our books. So we're going to give them we're going to give them more, and we're going to make it a slam dunk that you should take the money. So I wanted to show kind of a push number in this case versus one where it was clear. And obviously, if the number is somewhere in between, let's say it's 600,000. So let's say they offered you $600,000. Well, in that case, it's better to take the money, but it's not not as good as it would be if you had $750,000. Clearly, but 77% of the time, in this case, you would be better off taking the lump sum. So these are the kinds of decision points that we're looking at. So if you have this kind of decision and you need someone to help you calculate it, just shoot us an email at info@wealthnetinvest.com. We'll be glad to just run that calculation for you so you can get a good idea, make a smart financial choice relative to your pension. Okay, that's all for now. Louis Llanes with WealthNet Investments signing off. Happy trading and investing.
If you like this information, be sure to subscribe and follow us on Twitter and Facebook. The market calls are designed for informational purposes and should not be considered investment advice. As always, do your homework, assess the risk, and invest in light of your personal goals.